Hello everyone. In Chapter 13 we're going to be moving on to exactly what a corporation is, and more specifically how corporations can Hello everyone. In Chapter 13 we're going to be moving on to corporate accounting, namely what a corporation exactly is and how corporations can raise large amounts of money by selling ownership in their company in the form of stock. So what makes a company a corporation? Well, a company is a corporation if it is organized as a separate legal entity, which means you set the business up and the business exists on its own. There is no specific one owner of a business. There'll be tons of different owners of the business. And the owners of that business can cease to be owners. They can sell off their interest in the business. They can trade it to other people. So the ownership of a corporation is constantly in a state of flux. There are a bunch of benefits that we'll get into on later slides of why companies choose to incorporate, but it is quite beneficial to any company. So most of the predominant businesses you think of, the Disneys, Apples, etc. of the world, they're corporations. And they've set up their companies as a separate entity, not tied to any one specific person, that operates in its own distinction. So the unique characteristics of a corporation are firstly that it is a separate legal entity. Why is that important to a business? Well, if you are a sole proprietorship, say you operate a machine shop out of your garage, and your business borrows money which you cannot repay, you find yourself in a bad state of debt. If you are a sole proprietorship, your personal assets are tied up with that business assets, which means if you can't repay your business loan, the bank has every right to come and make you liquidate your own personal assets, your house and your car, to pay off that loan that you are obligated to repay them. Well, if you're a corporation, that corporation is a separate legal entity. It's not directly tied to its owners, which means if a corporation finds itself in an unfortunate financial state, the personal assets of its owners are not tied in with the corporate assets, and they are protected, which brings us to the third bullet, that no personal liability of the owners is the main reason for companies to incorporate. If the business fails, oh well, the business declares bankruptcy, but as an owner, you get to keep everything you have in your own personal life. And those owners are the shareholders. And for most corporations, they have millions upon millions of different owners. This is entirely different from a sole proprietorship or a partnership where you would have 1, 2, 3, whatever amount, a small amount of owners. Corporations have a ton, which makes it difficult for owners to have a say in the business. If you are one of a million different owners in Disney, you really can't call up Disney CEO and tell them you would like them to make a movie of a certain subject. It doesn't work that way. So in a corporation, the business is run by management. It's not run by the owners. The owners are just sitting there prospering, I guess, off of management's good decisions. But they don't have a direct path, unless they have a real significant ownership, to have a say in the business. So they call that the lack of mutual agency. Sometimes management acts in their own best interest, which would not be in the interest of the owners. Corporations, unlike sole proprietorships, have an indefinite life. If you are a contractor, when you retire, your business ceases to exist. But in a corporation, your ownership in that business can be passed along via selling that interest you have, those shares of stock, which means theoretically a corporation could last for 1,000,000 years, just constantly changing the owners that it has. Another huge benefit of incorporating is the way that you are taxed. If you are a sole proprietorship or a small business, your profits from that business pass through to you as a person, which means you are taxed on your own personal tax rate, which can climb to various different percentages. Right now it currently goes up as high as 34.7%, which is a lot of money to pay in taxes. In corporations, they're not taxed on that progressive system where it keeps getting higher and higher the more that you make. It's a flat tax rate, and as of now it is currently 21%, much lower than you would pay on your own personal marginal tax. So how do corporations get away with paying a lower tax? Is because of a concept called double taxation. Corporations, when they are profitable, have income, and if you are a shareholder, if you own part of that company, you feel like you should be entitled to a portion of that income, and they pay it to you in the form of a thing called dividends, which we'll also get to later. But that distribution to owners of the company's profitability also gets taxed on the owner's tax return. So there is double taxation in a corporation. You pay the corporate tax on your income. After that corporate tax is taken out, profits are distributed to owners, and owners have to pay tax on those distributions. Companies that are incorporated, when they make money, are not obligated to distribute every dollar to owners. It wouldn't make sense for them to do so, because then they wouldn't have any money still within the business to grow it, to make it bigger. So typically, when companies that are incorporated distribute a portion of their profitability, they don't distribute all of it. They choose to hold on to a portion of their income for the period to expand the business in the future. Which brings us to a very important account that is unique to corporations, and that is called retained earnings. Retained earnings is an equity account that tracks the portion of profitability that a company is choosing to hold on to instead of distributing to its owners. And on this slide, there are a bunch of advantages and disadvantages of incorporating, and it's here for your reference if you want to go and look up something for, say, a test. But there are a few points that I definitely want to talk about on here, and the first one is disadvantage number 3. Government regulation is expensive. When you incorporate, you become a publicly traded company. People can choose to buy in or sell out of your company at any given time. And they're going to want good information to make the decision whether to do so or not, which means you have to adhere to SEC oversight. The government is going to look at all of your numbers when you're incorporated and say, we like the way you're reporting this, but we don't like the way that you're reporting that. We'd like you to go and fix that. And that can be a task. Firstly, you have to file paperwork constantly, and there comes a cost of filing that paperwork. You have to hire a very thorough accounting staff that's going to go back and forth with the Securities and Exchange Commission to make sure that your numbers are in compliance with the generally accepted accounting principles. Incorporating, while it has a ton of advantages, that is the big disadvantage. If you're a small business, you don't have to worry about meeting with the Securities and Exchange Commission. The only people that you have to worry about, giving positive information to or thorough information to are anybody that you're lending from and the IRS when you pay your taxes. But when you incorporate, you have to worry about making sure the government okays every single number that you pass off. So that is one of the major disadvantages of incorporating, but it is completely offset by advantage number 1. Corporations can raise more money than a proprietorship or a partnership, and the reason they can do so is they have the right to sell off a share of ownership to anybody that wants to buy ownership in that corporation, usually for a pretty significant amount of money. And when corporations raise cash, they sell ownership in the form of stock, and they sell a large amount of shares, which usually go for a pretty good dollar amount a share. It is not unheard of for companies to raise $100 million in a stock issuance. So corporations can finance activities much, much easier than any other form of a business entity. So how is stock issued? Well, it's a multi-step process. And in the first step, each corporation has a board of directors. They're people that look after the interest of the owners, of the shareholders. And a corporation can't do anything without having the approval of that board of directors. So if a company wants to issue stock, the management of that company, the CEO, the CFO, needs to go to that board of directors and say, we're thinking about issuing this many shares of stock. And the board of directors is either going to choose to not allow that, or they're going to, as they call it, authorize the issuance of that stock. So your first step in issuing stock is it has to be authorized by the board of directors. Then you need to figure out how many shares that you have that are going to be ready to be issued at the time. And when you choose to issue those shares in the public, you make a public offering. And if it's your first one, it's called an initial public offering. You may have heard the term IPO before. That is when a company itself sells ownership to the public. And once the public owns those shares, well, it's their property. So they have the right afterwards to choose to not be an owner of your business and sell it to somebody else who would like to invest in that company. or they can choose to buy more from someone who isn't you, another owner that already has shares that doesn't want them anymore, so they increase their ownership by buying from a third party. And I talk about this because those later situations do not affect a company's financial position. When the company itself sells shares to the public, they're going to bring in cash. When the public sells shares to one another, none of that money is coming to the company. So the only time that you have to record on your books funds coming in from the sale of stock is when you make that public offering the very first time stock is issued from your company to the public. And we tier off how we refer to stock into three different phrases. The first, as I just talked about, was authorized stock. It is the number of shares that the board of directors of your corporation has allowed the company to issue to the public. Well, shares that are actually issued that have been sold to the public are called issued stock. So stock needs to first be authorized before it can be issued. And then there are a bunch of cases, which we'll also get to later in this PowerPoint, where companies will choose to buy back their shares from the public themselves. So all of those shares that have been issued at one point in time might not be in the hands of stockholders. So the actual portion of the stock which you once issued that is still actually owned by people besides your company is called your outstanding stock, which is how you figure out how much you're going to distribute for payments. So stock needs to be authorized first before it is originally issued, and then after it's issued, not all of those shares that have been issued are going to be outstanding because some of them you may have purchased back. And in graphical form right here, there's your representation of the three categories of stock. You will have authorized stock, you will have authorized stock that has been issued, and you will have shares of stock that have been authorized, then issued, and are still outstanding. But you can't ever have outstanding stock if it wasn't issued first, and you can't have issued stock if it wasn't authorized first. So you have to follow the process to get through to figure out how many shares of your company are actually owned by the public at any one given time. Here is a stock certificate. Back in the day when things were not so electronic, when you owned shares of a company, they would literally send you a piece of paper with your name on it and how many shares you owned. And if you wanted to sell off that company, you would have to go to the proper place bearing that certificate, hand them to them and say, hey, here's the 288 shares that I own of Smart Touch Learning. I would like to sell them. Does anybody want to buy them at this given price? So your ownership was represented by this physical piece of paper, and they still exist. These stock certificates are still around, but you don't see a lot of people actually receiving these and putting them in their safe or filing cabinet or whatever. And the reason for that is because everything nowadays with trading has been moved pretty much to online. There are several different places that allow you to buy and sell shares of ownership in a company. Vanguard, Ameritrade, Scottrade, E-Trade being four of the possible examples, though there are many more. And when you buy ownership in a company, that stock certificate transfers to you, but these institutions on the screen hold on to that certificate. So nowadays, your ownership in a company is recorded on a computer, and it is, stored in their database. And when shares are exchanged, well, then they come out of your shares according to their database into whatever person is buying from you. So now investors don't have to worry about the actual transfer of, the physical stock certificate. Everything is kept online. And typically, when companies issue shares, they issue them through a big stock brokerage. There are a lot of, Chase Bank does it. There are a lot of huge financial institutions that are the first people that actually buy and sell stock. And what they do is they buy a huge amount of shares at once from the company during that offering, and then they distribute them to the people, and the people trade them back and forth on the four sites that you see in front of you. Well, in recent times, people have started, especially smaller corporations, have started skipping the middleman. They don't go to Chase Bank or JP Morgan or any of those big, huge brokerages to sell that initial wave of stock. They will go right to an online trading institution like Vanguard, and they will offer the stock for Vanguard to buy out first, and then Vanguard will distribute it to the users of that particular thing. So initial public offerings have always been done by huge financial banks, and that is changing rapidly now, where companies are issuing stock for the very first time to the public via an online trading platform. What happens when you buy the stock? What does it entitle you to? What's the reason to buy it? Well, money is the reason to buy it. People invest in companies' profitability because they want to make money themselves. So the big basic right that a stockholder has is dividends, and that is a proportionate payment of the company's profitability equal to the percent of that company that you own. That happens periodically, usually every 3 months. So your 4 basic rights, the most important for most people being dividends, is the right to receive a portion of that company's income for the period. But that's not all that you get as well. Firstly, you get the right to vote. Corporate management typically doesn't let their owners vote on every little, thing. Should we switch our suppliers? Do we think we should change, the health insurance package that we give to our employees? Like small things like that don't go to a vote, but big things, should we branch off into this new field of manufacturing we've never been in before? Should we expand our operations to a brand new market in, say, Korea? Those are big things that have to be cleared by your shareholders. So when huge, game-changing events happen within a corporation, they have to pass a vote first. And how do votes work? Well, people get 1 vote for each share that they own. So stockholders have the right to vote. Point 3 is called liquidation. Companies can't sell off a bunch of stock, raise a bunch of money, and then decide they don't want to operate anymore, close up shop, and just keep all that money that came from shareholders. That would be a really dirty play by anybody. But to protect shareholders from that, they have the right of liquidation, which means if the company ceases to exist, they are required by law to sell off all of their assets, sell their buildings, sell their land, sell any leftover inventory that they have, sell all of their equipment, sell off any receivables they have on there, any investments they got to sell. Any type of asset the company has, they have to sell. They have to first pay off their creditors, so they would pay off any bank that they owed, any vendor they owed money to. And after they've liquidated all of their assets and paid off their liabilities, they'll have something left over, hopefully, which is their equity. And if you are a stockholder, well, you have a right to what's left over after the company has liquidated all of its assets to pay off all of its liabilities. So the right of liquidation basically says if a company ceases to exist and they have any leftover equity, they have to distribute it evenly amongst all the shareholders based upon how many shares of stock each owner has. And then the last one is the preemptive right. If you own, say, 30% of a company, which is a lot of stock, you would have significant say. Every time something went to a vote, well, you would have your vote would count for 30% of the overall vote, which means you are making huge decisions for that company based upon it. And sometimes corporations don't like one person owning that much of the company, and if they could, they would go and they would just issue new shares to water down that person's portion of ownership, refusing to sell to that one person. Well, you can't do that. So preemptive right means every time new shares are issued, every existing stockholder has the right to buy shares up until they maintain that same proportional amount of ownership. So if you for simple numbers here, if you were invested in a company that had 1,000 shares outstanding and you owned 100 shares, you would own 10% of the company. And if that company decided they were going to issue 500 new shares, since you owned 10% of the company before that issuance, you have the right to buy 10% of those newly issued 500 shares. You would have the right to buy 50 of those shares. So preemptive right, every time new shares hit the market, as an existing owner, you have the right to buy a proportion of those shares equal to the current portion of the company that you own. So stock comes in different classifications. We've already seen authorized, issued, outstanding, terms that you'd use to refer to stock. Well, the other 2 big ones are common stock and preferred stock. And common stock essentially is just basic ownership in the company. You have the 4 basic rights, if I back up here, that we've seen on the slide here. And you have the right to receive, profitability. The shares that you see sold on the market, Dow Jones, NASDAQ, etc., they're usually always common shares. They are the basic ownership in the company, but companies have a different classification of stock they can issue if they choose, which is called preferred stock. And preferred stock comes with benefits that common stock does not have. Those dividends, the required distribution for common stock, is tied to the company's profitability. So if the company has a period where they don't have profit, well, they wouldn't issue any dividends. They wouldn't distribute anything to shareholders because they don't have the money. That's how it works for common shareholders. But preferred shareholders, however, there's a stated value in the shares that say, we agree to pay this much every, say, 6 months. So with preferred stock, you get guaranteed payments of some sort. There's a thing called in arrears, which means if for some reason the company doesn't have the funds to pay you when it's time for you to receive your preferred dividend, the next time that they pay dividends after that, they have to pay you not only what they would have to give you during the current period, but also that payment that they missed before your common shareholders can get anything. So preferred stock, it's a guaranteed payment. You always get paid first. Stock will also have something on it called a par value. And if there's any one thing that I could change in accounting and get rid of, it would be par value. What is par value? Well, par value, in simplest terms, is the minimum amount further shares can be issued for. And to understand why it's there, you have to put things back in perspective. During the 1930s, we were going through a Great Depression. Companies were hurting in a bad way for cash. They needed to raise money. So they would go to the public and they would issue new shares, and they would issue them for, say, 50 cents a share, and they would raise money by issuing those shares at 50 cents a pop. And then the next month, they would still need more money. They wouldn't have enough funds to continue their operations, so they say, let's issue some more shares. Well, a whole bunch of people already bought them at 50 cents, and we know by the law of supply and demand, if those people aren't interested again, the only way to get new people in is to bring the price down. So a month later, after they just got done issuing shares for 50 cents, they would issue them for 45 cents. And then if they still needed money in the third month coming up, and they had to issue new shares, well, now again, while supply and demand states that you're putting more supply out there, the demand for it is going down, and when demand drops, price drops, they would be issuing those shares for 40 cents. And it happened a lot during the Depression, where people would buy shares, and then a month later, shares would be cheaper than they were when they bought them, and then further issuances down the road would be even cheaper, and it angered investors. Some fears that they were scared to buy stock because they're like, well, why don't I just wait a couple of months when that stock's going to be much cheaper? So they instituted this thing called par, which is that minimum value. If a stock has 50 cent par, that means that shares in the future can't be issued for any less than 50 cents. Like, there's a very minimum amount that the company is allowed to sell to shareholders whenever it issues shares of stock for the first time. And this concept requires companies to account for the portion of any money they bring in from stock which is attributable to that par value, and any portion which is in excess of that par value. Why would I get rid of this? Doesn't it seem like a good idea to have that minimum value on there? It does. The deal with it, though, is that from the 1930s until now, they've never really changed par value on stock. Verizon is a share that I have in my portfolio. It's currently trading for around $70 a share. Its par is 75 cents. There is no way that Verizon would ever, in their own, will issue shares for 75 cents or less. So par value was a good concept when it came in the 30s. However, nowadays it's a very antiquated concept. And that's unfortunate for accountants and accounting students, because GAAP still requires you to split any money raised by the issuing stock into what portion goes to par and what portion was in excess of par. And some states have said, yeah, par value's silly. We're getting rid of it. So there is no par stock. And a lot of states in the union, if you're incorporated in that state, you don't have to tie a par value to the stock. Unfortunately, most of us are going to reside in New York, and New York is one of those states that requires par value on the issuance of any stock. So I regret to tell you that since we are residing in a state that has par value, we're going to have to use par value on all of our shares. And lastly, on this portion of the slide, we have the breakdown of stockholders' equity for a corporation. So corporations can raise finance in multiple different ways, and equity is the value of the corporation. Well, for a corporation, we're going to split it into two different classifications, and they are paid in capital and retained earnings. What is paid in capital? It is value that came into the business by selling ownership. It's essentially the amount of money that was paid in from external parties because they bought shares of stock in your company. The other half of equity is your retained earnings. That is money made internally by the company. That is your net income that you've chosen to hold onto. So the value of the business can go up in two different ways. You can sell off a portion of that business at a profit to increase its value, or you can run profitable operations, having revenues greater than your expenses, and hang on to that money to invest in your company by buying new assets, etc. So stockholders' equity has two subcategories: paid in capital and retained earnings.